So in this session, what I would like to do is explain to you the rule of 78 and how this can be applied to subscription-based businesses. So an example of some of those would be SaaS, software as a service, or cloud-based companies that charge a monthly fee, publishing business. Example of that would be, I have a newsletter with stock tips, and I charge $20 per month to subscribe to that. Software business charges $100 a month for online accounting software. So there's other examples of these. Kind of a rental business might be another one. Something like Netflix that rents DVDs is an example of subscription-based business, and so on. So the one thing in common that these businesses have is that their revenues each month stack on top of each other, i.e. so the customers I acquired, for example, in January, if I had, take my software business, for example, if I was charging $100 per month and I added 50 customers there in January, I will have added $5,000 in revenue. In February, if I repeat that, I add another 5,000. If you add that to the January figure, my total revenues are now 10,000. And this carries on stacking on top of each other by units of 5,000. So if you run that the whole way down to December, there's a very simple formula to give you this figure here, and that's called the rule of 78. So let's just have a look at how that works, and quickly give you some rationale behind this, because I think it's important just for you to know how it works. So again, if we have January here, February, blah blah blah, down to December down here, we've got 12 months. And if we were assuming we were adding $1, and $1 equals one new customer a month. In January, if we added $1, February we added $1, March we added $1, and so on down here. We just add $1 of new revenue, recurring revenue every month. This would stack up as follows. Our total revenue per month would be $1 here. February it would be 1 plus 1 equals 2. So it would be 2. In March we would have 3, April 4, so on and so forth, until we got down to December. We would have $12 of revenue in December. If you add up all of these months here, and I'll go back to my green, if you add these up, guess what you get? Yeah, you get 78. So let's apply that to the example we had earlier on. So our assumption is we have a software business and we offer accounting software and we charge a monthly fee for it. So assumption number one, you need two assumptions for this. Assumption number one is we charge $100 per month. That's our average recurring revenue per user. That's our ARPU. And the second assumption we've got, number two, is we add 50 customers per month, and that's our customer acquisition rate. So if we want to now know what is our total revenue for 1 year, based on if this kind of repeats itself every month, it's a very simple piece of math. It's 100 times the 50, which gives us our monthly incremental revenue, times 78. And if we go to a calculator, I think that comes to like $790,000, I think. Sorry, $390,000 per year in revenue. So we've just worked out now how we can earn $390,000 in revenue per year with those two. Now you could go through this and vary it. Say our say we cut our monthly subscription fee to $75, and we know that that would mean the number of customers we get increases to 100, we would now know that this was $7,500 a month, and if you go $7,500 times 78, you get 585,000. So the difference between those two, 390, 1, 2, 3, is $195,000. So that, by cutting our price by $25, we would get additional annual revenues of $195,000.